Hi, I'm John Ross. I'm here with Mike Carr. We are at day 2 of the Total Wealth Symposium, and there's a lot of buzz. Everyone is very excited. Day 1 was awesome. Great time. Lots of good feedback from everyone who's here. And I just asked Mike to come on with me, talk a little bit about options. You might know his services, and I have a lot of respect for him and his depth of knowledge, and just in trading in general and in options. So thought maybe get on camera, talk with him a little bit, and maybe give you guys some helpful thoughts of if you are trading options, or if you're thinking about trading options, then this is the man to talk to. At the same time, I'm excited I get to go on stage tomorrow, talk about something we're unveiling. I've been working with Matt Battiali, and we have an options service on natural resources that we're going to be talking about tomorrow. So got to listen to Mike yesterday. He talks tomorrow as well. But just listening to you yesterday, Mike, there were a lot of good questions that you answered, and I just thought you might be able to give something to these guys at home.
Thanks, John. I'm excited about the idea of using options on natural resources. These are markets driven completely by emotion, and you're going to use a system to take the emotion out of it, so you'll be benefiting from the emotion but not making emotional responses.
Right.
Great way to trade it, and it's the right way to trade it.
Absolutely, yeah. Natural resources are sort of the stereotypical cyclically driven sector, and looking sort of at these behavioral cycles is something I'm going to talk about tomorrow. But I think let's just get into something just in general, some general questions that people might be having about options, whether it's in natural resources or whether it's something else entirely. So I guess my first question for you would be, why trade options at all?
I think the greatest reason to trade options in any market is it limits your risk. So let's say you bought gold at $2,000 an ounce and it fell to $1,200. You've lost $800 an ounce.
Right.
If you had used an options contract, you could have limited your risk to maybe $10 an ounce or even less. So by using options, you're not subject to those emotional collapses that we see so often in those markets.
Absolutely.
To me, that's the biggest advantage, and then you just have flexibility. Once you notice that gold is falling, rather than hold and hope, you're going to take advantage of that downside. Instead of using just a call option, you're going to switch into a put option, and you're going to benefit from that. Now, if we think about how we are as people, let's say I want to stand on the ground and jump. It takes a lot of energy to do that. But if I'm standing on a ladder and I fall, I'll go down fast. Now, it's the exact same with the markets. When you're falling, they go down so fast, and you're going to have options that benefit from that decline. So you're not only going to benefit from the up, you're going to benefit from the down as well.
Okay, so it sort of adds this element of versatility, I think. Being able to be flexible with the market and with the market direction. Now, is there any particular way you use options, or any particular reason or anything you target with your strategy?
There is. With options, you're able to really target the large gains, and you're able to do that because your risk is limited. You know that, for example, you may have $3 in risk per share, and you can shoot for 100% gain. Options and this whole idea of leverage really provide for small accounts to become large accounts.
Yes, absolutely. Now, for some of the people listening at home, when it comes to options pricing, that can get really complicated, and it's something you don't really want to dive into unless you have time. But when we see an options price, there's what's called in the money, at the money, and out of the money. Now, when someone's looking at an options price to consider what option contract they want to be in, what should they be thinking about when it comes to in the money versus out of the money?
If you're in the money, it's going to cost a little bit more. If you're out of the money, it'll be a less expensive option. But it's less expensive because it may have a lower probability of success. So really, you're getting what you pay for. Options pricing, like you said, is a complex subject. It takes a lot of analysis. first of all, what you're going to do is find the right market to be in.
Right.
That, to me, is your strategy.
Absolutely.
Then you've got to make the tactical decision of what's the right option. And let's say you find a $40 stock. Well, the $42 call is going to be out of the money. Might just be pennies to buy. Might be a great trade, but other times it might be better to buy that $37.50, pay up $3 instead of 20 cents, and actually have a higher probability of success. That's the tactical decision, just as complex as the strategic one.
So I guess if we could simplify it, is it safe to say that if you're purchasing an in-the-money option, you have a higher chance of winning,
You do.
but a lower chance of reward?
Correct.
But if you purchase like an out-of-the-money option, these are kind of the home run or the grand slams that people might want to go for. Because this is a limited risk type product, it gives you the chance to put a little bit of money in and potentially hit that home run, right?
Exactly. You can tailor reward to risk very precisely with options.
And for your strategies that you use in the services you do, where are you primarily as far as in the money, out of the money?
Right now, we're generally primarily just a little bit in the money, and that changes depending on market conditions. Week to week almost it changes. We're usually right close to the money.
Right, yeah, that's what I shoot for as well. I think it makes the most sense based on time frames and things, time horizon for your trade. So let me ask you this, when I was listening to your presentation, you were talking about the Greeks and how if you really want to have a trading strategy built around the Greeks, you got to have $1 billion, right? Or you got to be going to. So, but there was one that caught my eye when you mentioned something about delta. Can you tell us the importance of delta and how in a strategy like yours or mine, or somebody who trades themselves, how that might factor into a good, solid strategy?
Yeah, now a lot of traders get excited about the Greeks because they sound so esoteric and they must hold such useful information, and most of them don't. So delta technically is supposed to tell you how much an option will move based upon the move in the underlying stock. Forget about all that. That's not important because it's theoretical and it changes.
Right.
What is useful is if you buy a call, delta is your probability of success in that trade. So if you buy a call with a delta of 52, you have a 52% probability of winning. It works also with puts. Let's say you're selling a put with a delta of 80. You have an 80% probability of success. There's no other tool that lets us evaluate the probability of success so precisely.
Right. Now, I mean, that's the word that I keyed on when I heard you speaking yesterday, probability. Now, I think, if we can, the more a trader can look at the market with a sense of the probabilities for success, the more likely they're going to have a solid, consistent winning track record over time. As far as, when you're looking at an options contract and you're looking at selecting which one makes sense, do you use delta? Do you use that probability and set like a floor and say, I'm not going to take any trade with a delta under this number?
Yeah, I'm not going to take a trade with a delta under 45.
Okay.
Because then the odds are so much against me that I need basically, from a football analogy, it's a Hail Mary pass at that point.
Right. And
the markets are hard enough. If I have that clue as to whether or not it's going to work or not, it's not much point ignoring the data.
Yeah. Well, that's great. I think that's good. Thank you, Mike, for being here.
Thank you, John.
I'm looking forward to getting on stage tomorrow. I know you're on again. But thank you for you listening, watching from home. And John Ross, Mike Carr.